strip away some of the Dodd-Frank financial reform and consumer protection laws from back in 2010, it's a good time to ask, can we avoid another financial crisis? And we're fortunate to have with us the author of that book, Steve Keen, Can We Avoid Another Financial Crisis? Steve, thanks for joining us again. So is it possible? Can we avoid another financial crisis?
Well, we're avoiding a financial crisis in the same way you might avoid breaking your leg after jumping off a cliff, because you've already come down a substantial height from an excessive level of private debt, and climbing back up again to have another fall off that same cliff is a bit harder when you've got a pair of broken legs. And that's really the way I'd paraphrase America's situation. It had a financial crisis because of a debt bubble, private debt bubble, that's fallen a bit after the crisis, but you still have a historically high level of private debt. And though you won't have another crisis in terms of a precipitous decline like occurred back in 2007, 2008, you're never going to get much of a wind behind your back anymore either. So in that sense, America and the UK have avoided a crisis by having one and not having properly recovered from it. But the rest of the world, places like China, Australia, Canada, Belgium, Norway, Sweden, I think they're in for their own version very shortly.
You know, Steve, you mentioned in your book, and when folks look at economists like Minsky, you know, they contend that we will revert to forgetting the lessons of the past. And given what we are seeing in the U.S. and hopefully not too much in other places where they're trying to pull back on some of the responsibilities that were placed upon financial regulators, do you think we're headed for what Minsky said, that we're going to go right back to some of these problems again?
Well, we haven't learned the lessons from the crisis, that's certainly true. And if you look back to the Great Depression, we could have learned from that crisis about what to do and how to avoid another one, to really avoid letting huge amounts of private debt accumulate once more. But we've completely failed to learn the lesson every time. And of course, the regulators, when they start to think everything is okay again from the neoclassical mainstream economic perspective they have, they start stripping away all the measures we put in there to prevent that same sort of behaviour happening once more. So the behaviour will recur, and we're certainly seeing that right now. The same sense of euphoria will come back in again. But as I said, it's a bit like having had a crisis already and not having reduced the debt by anywhere near as much as it fell after the Great Depression. The headroom for another boom isn't quite there. So I think what's going to happen instead is the regulators will, as well as relaxing the laws, they'll also think, oh, we can put interest rates up again, we can start cutting government spending, and they'll re-trigger some of the deleveraging that gave us the crisis in the first place.
Exactly. Well, I want to go back to there was this thing, I know you're aware of it, but for our viewers, it was the Financial Crisis Inquiry Commission, the FCIC, and they came out with a report. They were authorized by Congress. I think it was 2011, and they talked about two primary culprits. Now, these are different than what you talk about, but I used to do this little poem, Steve, about thing one and thing two, and the first thing was the regulators and lawmakers were a problem because they lessened regulations. The last time we went through the thing you're talking about. And the second thing was that the captains of Wall Street took advantage of it. So I'll give you my little quick poem. Light markets, dark markets, big markets, small, red, green, and black markets. They traded them all. They were burning up the fiber. There was fire on the phones. And then what they did, they traded bundles of toxic mortgage loans. And the risk was so portable, it was so easy to use that sometimes they wondered just whose risk they might lose. And they traded and traded. It's what kept them alive. And they did so, this trading, 24/7, 365. Thing one and thing two, what could possibly go wrong? Now, so FCIC talked about those two things, but you're really focusing on debt. And why is it? Explain how debt is different and why that gets us back into this same old structure where we lose sight of the lessons and fall into the trap again, Steve.
Well, the fundamental reason it matters is that when you borrow money, if you're in an individual purpose, if you, let's say, have an income of $100,000 a year, and you're maxing out your credit card every year by $10,000, your total spending is $110,000, and you're the most popular person on Main Street, of course. Then you get to the stage you've maxed out 3 credit cards, you owe $30,000, and you think, oh, I've got to start paying my debt back. So rather than spending 110,000, you spend 90,000 and you pay 10,000 off your credit card each year. That means your spending falls by almost 20%. Now, that is something that applies at the individual level, and conventional economics says, oh, well, you know, when Bill spends, he borrows off Steve, so Bill can spend more, Steve less, and then when Bill repays, he's got less and Steve's got more, and it all balances out in the wash. That is wrong, completely categorically wrong, because when one person lends to another, there's no money created. But when a bank creates a loan, it also creates a matching amount of money, which the recipient then spends. So bank debt boosts the money supply and it boosts demand at the same time. So a rising period of debt, like you had private debt, like you had from about 92 through to 2007, gives you a apparently prosperous economy. But as soon as people find they have to start paying the debt down, or the banks stop wanting to extend that debt, the rate of growth of the rate of growth of debt stops. Credit disappears. It can go from positive to negative, and that's what happened in 2007. So you went from having credit being equivalent to 15% of GDP to minus 6%. Now, the economic discipline says that doesn't matter because it's the seesaw. They're completely wrong. The central banks are telling that these now, the Bank of England and the Bundesbank, and you have a 20% fall in aggregate demand, which is, by anybody's definition, a crisis. That's why it matters, but it's still ignored by mainstream economists like Paul Krugman, Larry Summers, and all that crowd.
Now, Steve, when you look at some of the numbers coming out, some of the figures in the U.S. and about debt that is accumulating and people failing to pay their mortgages on time more than they have in, I don't know if it's 6 or 7 years, do you think we're beginning to see some of the indications that we are headed down this rough road yet again?
Partially. I mean, if you look at the peak level of private debt that America accumulated during the bubble, it was about 170% of GDP. Through the deleveraging after the crisis, people going bankrupt, debt being written off and so on, it fell by about 20% of GDP to 1.5 times GDP. It's now rising again. It's rising at a rate of about 7% of GDP every year. Now, what I think is going to happen is that as that starts to occur, and you have the Federal Reserve believing everything's fine again because they completely ignore this issue, they'll start putting interest rates up, trying to head towards a rate of at least, say, 3%. They used to target 4% as their rate of interest. I think they'll target 3% this time. And the politicians in the Congress, they might go with Trump on the infrastructure spending, which will boost the economy through the government spending more than it takes back in taxes. But if the Paul Ryans of the world have their way, they'll start cutting government spending, spending on the poor, of course, and continuing spending on the rich. And what that will most likely do, the rising cost of debt and the diminishing amount of money being created by the government, will trigger what happened back in 1937, and that is the private sector will go back into reducing its debt levels again. Now, that was called the Roosevelt recession when it happened because unemployment, which had fallen radically from 25% of the population in 32 down to 11% by 36, rose again to 20%. Now, we won't see the same rise, but I think what you're going to see is a bit of a boom. The policymakers will get comfortable thinking everything's back to normal again, put the rates up, reduce government spending, and bang, the private sector will start cutting its spending once more to pay back that debt, and we'll go back into another slump. And that's really a wash and repeat that Japan has been doing now for 25 years.
Yeah, well, it looks to me like a lot that you say may happen is going to start happening, I don't know, pretty soon here. I mean, the U.S. Federal Reserve looks like they're going to go ahead and boost interest rates, not just now in March, but in the next several months. And the ECB looks like sometime later this year. So we could be well down that path. Hey, Steve, anybody wants to read your book, Can We Avoid Another Financial Crisis? They should do so. It's very interesting. But you've also written a comic book about economics as well. Tell us about that a little bit. Oh, that's
okay, well, this
economics. And what's the subtitle?
Taking the con out of economics.
Great.
And it arose in a funny sort of way. I had to fly off to give a conference speech in Canada a couple of years ago, and I was reading Larry Summers. That's Larry on the cover there, and he invented this concept he called the FERIA, which stands for the Full Employment Real Interest Rate. And this has never been used as a term in economics ever before. And in this one paper, it was there 21 times. And I was reading this thing in flight, thinking what a load of bollocks it was, frankly, and thinking it's almost like some particle accelerator or a quantum physicist has discovered some new fundamental particle. And I realized that was a great line to send up the whole idea, so I wrote a satire on that basis. And then that's what's been illustrated by a fabulous cartoonist. And then going across to a similar conference in France, I was reading about these two French economists called Cahook and Zeilerberg, who wrote a book talking about non-orthodox economists being what they called economic denialists. Now in France, denialists is pretty much accusing of being a Holocaust denier. And I thought, well, frankly, partly up yours. And I wrote a satire about them as well, saying they were part of the WHO, warning about the outbreak of a dangerous new virus called reality, which was affecting economists in the Midwest of America. And the only way to avoid the virus was to complete avoidance of reality, was the only technique that had worked to keep you as a mainstream economist. And I finished up with a satire on David Ricardo, who, though we know him as the father of the idea of comparative advantage, he was also a swindler. And this is actually historically true, and I had a fair bit of fun blending his actual role, swindling his fellow stockbrokers over who won the Battle of Waterloo, with swindling the world over the idea of comparative advantage. And this is all basically to take the mickey out of economics because it desperately deserves to be taken less seriously.
Take the mickey